don't really know where the world is gonna go. But now everybody knows that you can't stop for too long. Got to keep.
The first step in generating wealth is to pay yourself first.
But now everybody knows.
Stay tuned.
Stay protected.
Stay focused.
Stay connected.
There's a lot of different types of HELOC products that are now on the market, some of them geared towards velocity banking, and that's really good news.
This is probably the largest asset you will ever have in your life.
Right.
Here's some direction and some instruction on how to leverage this vehicle so that you can help yourself, help your family, accomplish your goals. We're not educated that way.
We use this strategy to pay off our home in 4 years.
Validation of your retirement account says what you thought was a retirement account is no longer one.
When I tell you, you're going to be shocked to learn. If you didn't come from a wealthy family,
You can make sure a wealthy family comes from you. So it starts with pay yourself first today,
Yeah, starting today.
right now. Put your money in somewhere secure. It's about the ability to not lose. I will take base hits all day long versus winning and losing. Somewhere secure, compound your money, and then you leverage OPM, other people's money, to exponentially grow it. That's how you generate wealth.
So whether you're joining us to crush debt or build wealth, time is the most valuable asset.
and we're so grateful that you're spending your time here with us.
Got to keep going.
Good evening. We hope everyone had a wonderful weekend and has had a chance to watch the last live stream, because what you're learning is about leverage, where your leverage is and how to use it. Tonight, we are going over a common question that you get, a conversation that you have probably every week, at least once a week, right?
Yeah, so we haven't talked about IULs and infinite banking in a while. We've been talking a lot about other areas of leverage, like self-directed IRAs, 401ks, stuff like that.
Right.
But weekly, a lot, especially over these last few weeks, since we haven't been talking about it, I get a lot of questions about infinite banking. I get a lot of questions about people who currently have life insurance-based policies and are just trying to understand why their policy does this.
Yeah. Why
There's-
doesn't it do what you talk about?
Right, exactly. Why doesn't my policy function like everybody else's policy?
Well, here's the good news. The good news is that more people are finding more strategies to be able to crush debt, to be able to build wealth, and they're exploring with some of these alternative strategies. I would say some of them, I would say, are rather new or newer to the majority of communities. Some of them are really old, and the concept or when it was born was also old. So, are these particulars taken into consideration when you learn a new strategy or new to you? Probably not. But the good news is we're going to peel back some layers to be able to better help you understand a bit, regardless of what strategy you are attempting to follow in order on your wealth building journey, in order to put yourself in a better position, financial security, financial stability, and a financially free future. You'll know what to look for, how to make confident and educated decisions, because we're going to peel all the layers back. What's at the center of all of this? What helps you make those decisions along the way, and what that are impacting the results, to ask the question, why is it not working for me? Right?
Exactly. Tonight, we're going to arm you with some tools that you can actually take with you to go, you know what? I don't think this is right for me because of A, B, C, or D, or let me make sure my agent understands this is the structure that I'm looking for and why. So we're going to peel back all of that.
Yeah, really appreciate that. Well, I'm excited to get started. Welcome everyone in the chat. If you're here, if you're new here, if you're just tuning into us, we love to see who is tuning in and who's coming back, who's joined the fam. Yeah, this is a great place. These live streams are a great place to meet other people who are on the same journey you are. And it's also a great place to ask questions, because many people are also following these strategies and can share their experience right here in the chat. And it's a great place to ask questions. So as a reminder, put a Q in front of your question if you have a question for Donnell or I, and that's how we would be able to identify. If you just have a question for the majority of the chat, feel free, jump in. But we love to see you guys all here. Welcome. And ready to jump in?
Of course.
Okay, let's go. Let's do it.
1, 2, 3.
The goal should be, where can I achieve exponential growth? Exponential growth.
Let's just get into it. Let's just get into it.
Right. So, as we mentioned, this is a question that I get often. It's, I have an infinite banking policy. Why isn't my infinite banking policy functioning the way it's supposed to? Well, there's so many different layers to this, but let's first start with infinite banking is not a policy. There's no such thing. You can't get one. Infinite banking is actually a concept. And so we're going to break down really at the root of why things are the way they are and what you have to do about it. What can you do to make sure you don't fall into the same boat as to getting something that you thought was going to function and work one way, and then all of a sudden it's not. So we'll be digging into all of those details. But as it relates to infinite banking or banking on yourself or whatever the case may be, what's the whole point and purpose of getting a policy like this anyway? In most cases, it is absolutely about leverage. Leverage comes in many forms. Maybe it's about, you know what? I want to be able to invest in things that I want to invest with, or I want to invest in things that want to take priority to be able to invest with. And I don't want to have to worry about asking for permission to get financing or having to get approval, or maybe my credit isn't the greatest or my DTI is impacted. I want a product, a vehicle that I can leverage, borrow against to be able to invest in what I want. Maybe it's I'm looking for liquidity. I don't have anything that I want to invest in today, but I at least want the ability to be able to take action when I can. Tax advantage accumulation, like who does it? Who wants to make sure that their money is growing and not have to worry about some tax implication as a result? A flexible line of credit, meaning I want my money when I want it and be able to use it when I need it. And you know what? If I need if I need $5,000, I want to be able to access that. If I need $50,000, I want to be able to access that. Maybe the amount that I need fluctuates over time, and I want some flexibility in that opportunity. And then volatility buffer. A lot of my clients are just like us, and that is we do not have time for loss. We do not have time for being concerned as to whether or not our money won't be in a position to be able to work for us. And then ultimately, it's less about wealth and more about legacy. Because wealth, it can dissipate, but legacy lasts for generations. So the objective is, hey, is there an opportunity to put my money in a position to where not only am I able to use it today, but also it's in a position to where if I'm no longer here, it's still working for me. So what is leverage? We talk about leverage a lot on this channel, but to oversimplify it, it's about taking one resource and using it to multiply another. It's access to a vehicle that can allow you things to multiply over time. So whether that's, there's many different types of leverage, but I was about to head down a path that I don't need to because we'll get there eventually. The thing about leverage is once you see it, you realize it's everywhere. Once you understand how leverage works, you realize, man, I have not been paying attention to how much leverage is around me, as in your time. How many of us have to ask for permission if we want a day off from work? The reason that happens is because that company that you work for is leveraging your time to make money. Most people think they are leveraging their own time to make money, but actually you're not. When it comes to the company that you work for, they are leveraging your time, and you get a small piece of what it is they make, but ultimately it is your time that is the most valuable, so they are willing to provide your salary to do so. There's so many different areas of leverage that we use. Google, AI. Who doesn't have Chat GPT as a part of their family? So that opportunity to be able to leverage systems and AI and leverage your education to put you in a better position to be able to gain new skills so that you can do what? Put yourself in a better position so you're not expending so much of your time to be able to make that money. So my point is, leverage is everywhere. It is all over the place. The question is, do you understand how to use it? Do you understand the best place to put this leverage in position so that you can benefit from it? Or are you just being the recipient of? Is that a question?
Yeah, I was just going to say that not only are we using leverage, others for leverage or other things,
Right.
leveraging other things, that we're also being leveraged.
That is correct. That is correct. And I go back to that timepiece. We think it's us, but actually it's the company that we work for leveraging us. So yeah, no, spot on. And in addition, there are different types of leverage. Meaning there is financial leverage. Financial leverage is just as it sounds. It's those mortgages, HELOCs, lines of credit that you use to be able to take action. There's operational leverage. Knowledge can be considered leverage, meaning Sometimes, as the subject matter expert or the smartest person in the room, your ability to be able to leverage what it is you know to be able to accomplish goals is there. Asset-based leverage, like your 401ks, IRAs, 403bs, properly designed cash value life insurance policies, meaning there's leverage all over the place. And this, I think, is my favorite, and it's one that until I saw it, I want to say it's not something that I was really conscious of in that moment, and that is mindset. You can either have a scarcity mindset or a growth mindset. Which one do you have? And that mindset, leveraging that mindset, it can be a key, I'll call it, piece of the puzzle to allow you to accomplish these other goals.
Man, that could be a whole other live stream.
Absolutely, absolutely. So and sometimes, and I think the piece that jumped out at me is this leverage consistency for freedom. How many of us are locked in our own jail simply because of our mindset? So again, my point is there are many different types of leverage, and when you understand where it's located, you realize, you know what? There's an opportunity for me to put this leverage to work to better benefit me. And so now I want to play a quick game. I don't know who or how many we have in the chat. It was kind of short when I came up here, but we want to play a quick game. And so I saw Gabo, I saw Nathan in there. So do me a favor. We want to guess what. Oh, I guess I can do it as a game show host. Guess the type of leverage that we have. And got a little game show music for me. That's awesome.
Yeah, I put some game show music on.
Appreciate
You guys can hear it.
So, and the first one I'll actually give it to you. So, controlling large assets with a small down payment. What type of leverage is there that allows you to be able to control large assets with just a small down payment? Anyone know? And again, I'll give you the first one. Mortgage bank financing allows you to control a large asset with only a small down payment. That's where mortgages come into play. Now we can argue whether or not that mortgage puts you in jail or not, meaning how much flexibility do you have? But the moral of the story is it gives you a large asset for a minimum down payment. How about leveraging other investors' capital for short-term deals? What type of leverage allows you to leverage other investors? Let's just start there. Whether short-term or long-term, what other type allows you to leverage other investors? How about private lending? We do it often. Actually, this is some of my favorite opportunities come from being a hard money lender, being able to take advantage of opportunities that normally we wouldn't even be allowed in the room. But because our dollar speaks, our dollar puts us in a position to be able to take advantage of opportunities that normally we wouldn't. How about being able to tap into idle equity to fund new opportunities? This one should be easy. Tapping into idle equity, idle, keyword, to fund opportunities. What do you think? How about one of my favorite vehicles that we use on this channel is tapping into home equity line of credit, leveraging your home to be able to put yourself in a position to be able to take advantage of things that otherwise maybe you wouldn't. Using your home equity line of credit to fund your policy, using your home equity line of credit to do velocity banking. Like there's many opportunities. How about extracting equity to redeploy into other investments? Again, extracting the equity to redeploy into other investments. How about a cash out refi? Point of this is there are many different types of leverage and there are many different vehicles that can be used to be able to do so. How about using revolving capital to bridge deals or renovations? Again, this is another one that should be fairly easy for my real estate investors out there. Using revolving capital to bridge deals or renovation. Credit cards, business lines of credit, PLOCs, BLOCs. There are all these vehicles that, you know what, I'm getting them for a specific reason and I'm using, and that reason 9 times out of 10 is specific to, it's either business related or personal as to a line of credit to bridge an opportunity or also to do renovations, get those countertops that we need replaced. How about using the seller's terms or existing financing to control property without new debt? How about seller financing a sub 2? Sub 2 is actually a pretty powerful tool. we've never talked about it on this channel, but that is also one of those areas of opportunity where if you have small capital, like a little amount of capital, sub 2 opportunities are pretty profitable and a viable option for you to be able to jump into. And then the last one, leveraging other people's capital, credit or resources to scale bigger. Leveraging other people's capital, credit or resources to scale bigger. How about joint ventures and syndications, which we highlighted last week when we were talking about different ways to be able to use your self-directed 401k to be able to generate mailbox money. Moral of the story is there is a lot of leverage out there. There's a lot of opportunities to be able to use it.
Wait, I got a sound effect for the end of this segment. I got to play it. It's that important. All right, there it is. Continue, carry on.
So there's a lot of opportunities around there, but is that everything? Like, what are those areas of leverage that we might actually be missing? And I go back to this. Once you see it, leverage starts to pop up everywhere, or you start to ask questions around, how can I use this to my advantage? Because most of us live in a home, and 9 times out of 10, that home is our largest asset that we will ever have. But how many of us understand how to leverage our home to be able to work for us? So one of the biggest pieces is when you have leverage that's sitting, waiting to take action, but maybe you don't understand how to use it. And ultimately that fits right along the lines of how equity works, how equity in your home works. Meaning, let's say you're saving or investing, or you're building up equity inside of your home. If you don't understand how to use it, that equity is sitting there dormant, not doing anything for you. Yeah, it's safe. It's not going anywhere. But if you don't understand how to use it, it ultimately is lost velocity for you. That money sitting dormant, that money is not taking action. You're not putting it in a position to be able to work for you. There's no opportunity for your money to make money. You know how compound interest works, right? Your money makes money, and the money that your money makes more. Well, if I'm living in the largest asset I will ever have, is there an opportunity for me to be able to access that equity in my home so that it's not sitting doing nothing? That's the question. And so ultimately, the idea is when you're trying to understand how to use leverage, realizing that it's all over the place. And the truth behind this is your money will do exactly what you allow it to do. Meaning, if you don't put your money in a position to where it can work for you, it won't. So the idea is whether you will or you won't, it's kind of up to you. So the idea for today is this is not just about infinite banking. This is not just about having a policy that's designed for me to be able to borrow against, use as leverage, do infinite banking, whatever the case may be. It's understanding how leverage works. Because if you can understand how leverage works, you can also understand why, or have a better understanding as to why maybe this policy isn't doing what it's supposed to do. So your money will do what you allow it to, and that's more or less. But let's take a trip for a minute, if you don't mind. Let's slide back maybe about, 40 years or so, back to the 80s. Again, as we talk about leverage and understanding where leverage is located, is there any leverage that we might have missed? Is there any leverage that we haven't dug into the details around or talked about? Well, back in the 80s, there was this fine young gentleman that came along.
This is my favorite part, by the way.
That basically stated, wait a minute. As he was learning about leverage and realized as he places his money in a position to be able to work for him inside of most banks like all of us do, understanding how banks work, banks take your deposits, lend them to others. Yeah, they may turn around and provide you some small amount of interest, but ultimately that money is working outside of the bank itself as though it never left. So this is what banks do. Banks don't make anything. Banks don't produce anything. Banks create arbitrage. Banks create a spread. So what if you could create your own spread? What if you could be the bank? And again, this is 40 years ago. This was identified. There's an opportunity to be able to put myself in a position to where I can also be a bank. Did you have a question, sweetheart?
Yeah, just for those who might wonder, did he really say these things? I just want to say that there's no proof that he didn't.
Right.
Okay.
How do you know?
We just have to assume that he was this cool to be like, you know what, back in the 80s,
Well, and this is my favorite.
yeah,
I guarantee you Nelson had him a mixtape.
don't call it a comeback mixtape.
That's right.
I've been
there
here for years. That's right. And there's no way to prove that he didn't have these things. He didn't have this whole fit and he didn't speak like this. So just for anybody who wants to jump in the comments and say that doesn't even sound like Nelson Nash, how do you know?
Right.
How do you know?
Show me the evidence. And it gets even better. Because the truth is, if we're able to put ourselves in a position to where our money can make money, meaning we can understand where leverage is located and become the bank, what's left? If we can put ourselves in a position to become the bank, we have the opportunity to be able to exclude all of these other institutions that force us to get qualified, force us to get their approval to be able to take action. The goal for all of us is to become our own bank. And I don't know what it's giving, but it sounds like it must be giving wealth.
Justin and I were talking about it. Like, what was Nelson Nash really experiencing during this time?
Giving? Is it?
And he was like, listen, it's giving wealth. And I was like, yeah, no, we're putting that on there. And it's because that's exactly what he was doing. He was like, how do I eliminate needing permission from these people? Because clearly they're just making conditions harder and harder. And I'm losing deals. I'm never going to get to my goal if I have to keep going through this red tape and joining this circus every single time.
That's right.
It's not designed to benefit me. So how do I remove them from the process? I got to learn their process. I got to learn how they work. I've got to, once I start realizing and picking these layers apart, now I get it. I get why this wasn't working for me either. So people who are asking, why isn't infinite banking working for me, is the same question that Nelson Nash was asking before he dove in to figure out why real estate investing, why traditional investing strategies weren't working for him either. He had to learn how it was functioning first. And what he learned was they never stopped compounding.
Right.
They're making the money. They are never taking the money out. And that's where he came up with this idea based off of the landscape of that day.
Right.
Right.
And not only that, it's the tools that were offered during that day as well, meaning this is all built and based on a whole life policy, right?
Right. Right.
Why? Because that was the tool then that would allow him to be able to put himself in a position to where money can continue to compound.
That's right. It's not, he did not talk about crypto because he didn't agree with it. It didn't exist for him to even consider, right? So that's something that has to be. And I look at this the same way that people split up ideologies, right? Sometimes they focus on only one piece.
A scripture,
right? And they forget all of the rest of it that supports that or that makes that make sense. And so when you remove all of the other pieces or particles of that, you want to say, anybody can say anything that they want. I mean, we don't know that he said this, right?
Thanksgiving.
Yeah. I mean, people can say what they want. But
I didn't say just do it though. He had to. We all did.
I have to believe he was this cool though.
Absolutely, I agree.
Yeah. Okay. But the point is that when he was writing this book, right? This is the point. He was only utilizing the tools that were there.
Right.
He was now people have since almost treated this like a Bible, right? And they have picked out scriptures and forgotten the rest. And what he absolutely included in this book was something that is abandoned by this almost nearly by this entire community. And it is a very important concept. I think this is the concept that probably led him to figure this out in the first place. And why haven't more people figured more things out? It's the very thing that he put in this book, and he already called it before. He even published a page of this. He said this was what was going to happen, and still people ignore this part because they're not reading the whole book. What was it, Donnell?
Arrival syndrome.
That's right.
If you allow yourself to get to a point where you think you know everything, your ego ends up taking over, and you forget the purpose and the mission. The purpose and the mission is to become your own bank. The purpose and the mission is to make sure we can assist you in doing so. The purpose and the mission isn't the vehicle that's used. And my favorite slide is this slide. And it's not because of infinite banking, because I understand today's live is why isn't infinite banking working for me? It's not about infinite banking. It's not even about becoming your own bank. It's not. It's not even, it has nothing to do with any of it. What it is about is a concept. Meaning, I get a call saying, I want you to look at my infinite banking policy. I have to pause and let them know you don't have an infinite banking policy.
Right.
You might have a whole life policy. You might have an IUL, but what you don't have is, definitely what you don't have is an infinite banking policy because it doesn't exist.
And did you know
strategy?
Yeah, and did you know that it's actually illegal to call it that the insurance companies, they do not want them marketed as such. So even though that's the street term, back to Nash on the streets, okay? Even that's the street term for it, that's actually not okay. They do not want them called that. So if you were to call your insurance company and say my infinite banking policy, they'd be like, I don't know what you're talking about.
Right. That's it. And so, as we focused on why isn't my infinite banking, why isn't infinite banking working for me? It's rooted in making sure we first understand that infinite banking is a strategy, and that strategy only works if it's applied effectively. And what is that strategy about? That strategy is about you. We've talked about all of these different places where leverage is located. We never once highlighted that maybe I'm leverage. I understand my time being leveraged, my labor being leveraged, but what if my existence is actual leverage? Understanding how to better design that structure around me so that it could be used to generate and build wealth. Like, mind blown. And so the cool part about that is it's been us this whole time, meaning you have been the leverage your whole life. And I love your play on whole life here. That was pretty amazing. That's
Thank you.
But you are the leverage. It is about you. And so, but here's the problem. When we deep dive infinite banking or the infinite banking concept, there are some key areas that you have to pay attention to. Because if not, IBC will break. And once the concept or the strategy is broken, there is no leverage. You're going to lose your leverage. So understanding what these pieces are very, very important. And I'm putting them in two buckets. There are some things that you control, and there's some things that you don't. I am not going to spend a whole lot of time on those things that you control, and that's here. Funding and time horizon. I highlight what it is. Funding, let me make sure. Yeah. Funding and time horizon. Oh, actually, I'm going to do that later. So I'm not going to spend a whole lot of time on these. My point is, this is what you control. Funding, time horizon, loan management, assumption, problems, tax and regulatory events, and suitability misfits. We can dig into those details later if you want to talk about them, but I want to focus my attention on the pieces you cannot control. Because when you ask the question, why isn't infinite banking working for me? We have to first make sure it is not because of an issue that you cannot control. Meaning, did you receive the policy that was designed correctly? Is the policy that you received from a carrier that understands what this structure needs to look like? Is the product itself efficient? You can't control these things. But if you got a policy that doesn't check these two boxes, it doesn't matter what you do. This strategy will not work for you. So I want to make sure it's clear. There are areas that we control, and there's areas that we don't. We want to focus our attention here. And that focus is on structure. It's all about how your policy is generated, created, structured, who created it, who it's with. And the key piece is you're borrowing against capital. You're not borrowing from your policy. You're borrowing against your policy. Meaning what's happening inside of your policy doesn't change. You're just borrowing against the cash value that's in it. And that's powerful. So it's about structure. And again, the infinite banking concept is a concept. It's a strategy. So why isn't this strategy working for you? It's rooted in those areas that you don't control. So what we want to do is break down and spend a fair amount of time detailing what are those things that you can't control. Why? The better you understand them, the better it will be for you to be able to ask questions just to make sure you're not stepping into something that you end up regretting having. So I wanted to highlight this a policy. So this is a whole life policy of one of my clients, and let me start with, there's probably been this year, if I had to put a number on it, maybe 200 policies, 220 policies that I've reviewed this year around the infinite banking concept, and all of them have been whole life policies. And I'd say of that 200, 250, I don't know that I could identify one that was fully structured correctly. So it first starts with, what's the point? What was the purpose? Why did you get it? Again, I want to be able to control my finances. I want to be able to maintain liquidity.
Yeah, they can't see
And
it.
I can't make it bigger because of the
Oh, got it,
slide.
got
So
it,
it kind of
okay.
is where it is at the point. But my point is, it's about what is the point? It's control. It's to maintain liquidity. It's tax advantage. It's flexible credit line. It's a volatility buffer, legacy protection, and ultimately it's leverage. Right. The cool part about most, if not all, of the policies that I've identified is they are all structured to handle those issues. If the goal is control, you have control over the cash value that's being generated inside this policy. If the objective is liquidity, you have access to your cash value, which makes it liquid. If you're looking for a flexible credit line, all of those pieces, all this policy checks the box. That has nothing to do with the strategy of infinite banking. Where infinite banking breaks is in these spaces. And I go back to, it's related to the areas you can control compared to the areas you can't. Funding and time horizon is about what? Funding time horizon is saying, am I putting enough into this policy? Based off the my age, what my goals are to be able to use this policy, am I putting enough in? Loan management is just basically saying, when I borrow against my cash value, am I borrowing too much too soon? Do I have a process or a strategy to be able to repay it? Assumption problems, meaning the impact of monitoring the spread. If I'm getting a life insurance based policy and I'm borrowing against it at an interest rate. Is the rate that I'm borrowing more or less than what's being generated inside the policy? Regulatory events, tax and regulatory events, meaning understanding what it takes to impact my policy or what may cause my policy to lapse. Meaning, am I on a schedule to where I'm funding my policy consistently, or am I putting myself in a position to where it may lapse if I stumble? And then the last one being suitability misfit. Maybe this is not the time for me to start this process. Suitability is saying, am I putting enough into this policy so that it's generating the cash value necessary so that I can accomplish my goal? These areas are controlled by you. Everything else is based on who created it. This section is outside of your control, and that is policy design and mistakes and carrier and product risk. So let's kind of deep dive or dig into what I mean by that. So as it relates to policy design and carrier and product design and policy design mistakes, which are different. What do I mean? Well, from a carrier and product design perspective, where is this policy coming from? Who created this policy? What is the life insurance company where this policy is existence takes place? Is this an A+ rated life insurance company? Is this a mutual life insurance company or a stock-based life insurance company? What does that even mean? All it's basically saying is is this a life insurance company that is focused on you and your goals, or is it a life insurance company that's focused on the bottom line? When we're talking about infinite banking, you want a policy where the holding company is a mutual life insurance company. Why? A mutual life insurance company is based on or is built on the constituents who are contributing to the policy versus a stock-based life insurance company like State Farm is focused on the bottom line, the stock price. And then is that policy built or designed with the lowest amount of expenses? Is the loan rate, what is the loan rate versus the growth rate? Is this single policy management? Am I focused on getting one policy at this time, or am I required to get multiple policies based off the MEC limit? And liquidity. How much money can I access and when can I access it? And then the last piece, which is probably the most important, match automation. These pieces are really these pieces are kind of hinge upon the carrier itself. Meaning, is this a mutual life insurance company? Is this F&G? Is this Mass Mutual? Is this Mutual of Omaha? Or is this State Farm? Is it Prime America? Kind of hinges upon the carrier itself. There's not a whole lot that can be adjusted there because it's either the product functions a certain way or it doesn't. Those expenses are usually set. That loan rate versus that growth rate, the loan rate inside of the policy is traditionally set. Single policy management is there's a little bit of flexibility there, but that's kind of set as well. And then how much liquidity is generated is really based off all of these factors combined. And whether or not that life insurance company allows for match or automation is kind of up to them. But these other pieces, the policy design mistakes, is what we want to deep dive today. These policy design mistakes, whether the policy itself is max funded or underfunded. What does that even mean? How much is working for you in year one? Meaning, as you contribute to this policy, how much access do you have to the amount that you're contributing in year one? Is the death benefit increasing or decreasing? What is the product type? Is it an IUL? Is it a whole life policy? Is it an IUL with leverage? Is it a universal life policy? Is it a variable life policy? What is the product type? The break-even point, where? As I'm contributing into this policy, what point does it break even? And the last one is agent. So if we were to go one by one, looking at the policy design mistakes, let's start with, is it underfunded or is it max funded? Looking at this policy and the snippet of the policy that I have, the question is it underfunded or is it max funded? And as we identify the answer to this question, I want to compare it against a properly designed policy. So what I want to do is compare a whole life to an index universal life with leverage, meaning this is what the client has. And the statement was, hey, I have this policy that doesn't really allow me to do infinite banking the way I'm supposed to. And what does it look like to be able to have the properly designed product? And this client is actually putting in $30,000 a year. And that $30,000 a year inside of his whole life policy is building a certain amount of cash value. That $30,000 is building somewhere around, at the end of year one, it has somewhere around $18,776. But the first question is this policy max funded or is it underfunded? What does that mean? Am I buying too much life insurance or not? And that's a yes or no question. Well, how do you know? The best you could do is compare it against a different policy. And so in this case, we've got a whole life policy compared to a properly structured IUL. Is the death benefit, am I buying too much life insurance for the amount that I'm contributing? Well, at $30,000 annually, we're buying $761,000 in a whole life policy. And at that same $30,000 annually, we're buying $638,000 inside of this IUL. I'm going to say, even though there's about maybe a $90,000 difference between these two numbers, I'm going to say they're both somewhat comparable. So from a max funded perspective, am I buying too much life insurance? I'm going to say not so much. But when we peel back the layers even further, it will more come to light as to whether or not there's an adjustment that could be made here, because this is a direct impact as to how much cash value you're generating. So again, question number one, is my policy max funded or is it underfunded? Meaning, am I buying too much life insurance or not? Is the first question that you want to ask as you're trying to identify whether or not your policy is or isn't working for you. Go ahead.
Okay, most people, when they're getting their policies, first of all, I don't know if everyone's following, because sometimes when you pull up these policies and or illustrations and start going through them, I wonder how many people are like, okay, you lost me. So that's one. We would love to have that feedback so that we know what kind of support do you need, maybe a breakdown in how to read a policy. Again, we've done that before, but of course it's, sometimes they're buried and hard to find. We can do that tonight though, if you're watching and you want that type of deep dive. The other piece is the majority of people who are opting into cash value life insurance policies for the purpose of infinite banking, they are not going, can you walk me through the illustration? They're going, how do I use it? What can I use? And what do I need in order to use it in this particular way? So for instance, when you're asking the question, is it underfunded or max funded? The question they're asking is how much and when can I access it to put it into motion for my goal? And let's just say that one of the biggest use cases is real estate investing.
That's right.
Right. So that's usually the question. They're not asking underfunded, overfunded, because they probably don't even know how to ask that question, right?
And that's the point. The point is arming yourself with the right questions to ask, because if you don't, you may think you're walking into a policy where, hey, all I want to look at is the bottom line. Can I access my cash value or not? Yes, you can. Okay, that agent accomplished the goal that you said you wanted. But when you go to use or leverage those dollars, you learn at that point that, whoa, my policy is imploding after I've leveraged or borrowed against it the first time. Why is that? It's because we missed an opportunity to be able to ask more questions.
Okay, so just real quick, because Ty's in the chat and she's like, yes, that's me. I am people, okay?
I am they.
I am they. I'm a little lost, but I need to look into the policy examples a little more. I think that the majority of people, they understand IBC, infinite banking, the concept of banking on yourself,
right?
Love the idea. But when they have to go looking at all of this, right? Why am I pointing the wrong way? Okay, here we go. When they have to go looking at all of this, it's weird for me to point. So forget it. It's confusing. So let's just walk people through real quick. What are they looking at right now? Can you just walk? So because you're going to be showing a lot of this, can you just give a basic, explain it to us like we're 5. What the heck are we looking at?
So what you're looking at is an illustration and when you say, hey, I want an infinite banking life insurance policy, it doesn't matter the type, whole life, variable life, doesn't matter. You're going to end up getting an illustration that's going to show, as you contribute to this policy, what is the breakdown of those dollars over time as you contribute to it.
Yes.
And in this case, this gentleman is contributing $30,000 every year. Year 1, starting at age 41 till age 60, putting in $30,000 a year. We can discuss whether or not you're obligated to fund your policy for this long, but this is just the structure of this current policy in this moment. And so the annualized premium outlay is how much is being contributed over that period of time. In a whole life policy, the total net cash value is how much of that 30,000 is accessible to you in that year. So again, calling out these numbers, in year 1, you put in 30,000. The total net cash value in this whole life policy, meaning the total amount that you have access to, is 18,776. This section is specifically related to what this whole life policy would do. The total net death benefit is the amount of death benefit that your beneficiaries would receive, God forbid, if you pass. So total net cash value is how much accessible cash you have to be able to borrow against and do actual infinite banking. The total death benefit is how much life insurance death benefit is life insurance plus cash value. The total death benefit is what happens if you pass. If you pass, this dollar amount goes to your beneficiaries. And so the first question that we talked about wanting to understand is, are you buying too much life insurance or not? As I mentioned, there's really not enough information on this sheet to be able to tell, but that's the question that you want to ask to the individual that's supposed to be a subject matter expert selling you life insurance. It's very simple. Is my policy max funded? Yes or no? It's the question that you want to ask. And this section of this picture of an illustration is specifically related to an IUL. So this section is based off this $30,000 being contributed. This section is being based off this same $30,000 being contributed and how it performs differently. So again, if we just look at year 1, Inside of a whole life policy, we're saying $30,000 will give you access to 1876 in year one and a total death benefit of 761,000. Inside of an IUL with leverage, a specifically designed IUL with leverage, that same $30,000 would give you liquidity access to about 29,435, a surrender value, which is how much you can use, about 13,598, and a death benefit of 638,530. From a max funded perspective, meaning am I buying too much life insurance or not, the goal is to buy the least amount of life insurance possible. Why? The less life insurance you buy, the more money that's working for you. The less life insurance you buy, the less money the life insurance company makes. So more of your money is going towards gaining and building cash value for you. So we want the smaller death benefit. Hard stop. So that's first one, underfunded or max funded. The second is how much of what you've contributed into this policy is actually working for you in year one. So again, looking at both sides of this illustration, in a whole life policy, we're looking at year one only. And in this case, we're putting in $30,000 into a whole life policy. In year one, the total net cash value in year one is 18,766. So how much money is working for you inside this whole life policy in year one? Well, I put in 30,000. I've got 18,776 working for me. That means the difference between those two numbers went where? So the reason you're asking this question, how much is working for me at year one, is because you want to know where the money went. If I put in $30,000, why don't I see $30,000 sitting in my total net cash value in year one? And then as it relates to an IUL, I put in $30,000, I've got 29,435. It's not 30,000, but I put in 30, I don't have 30,000 working for me. I have $29,435. That's a difference of somewhere around $600. So in one of them, I put in 30,000, there's about a $12,000 difference. The other one, I put in $30,000, there's about a $600 difference. Asking this question allows you to go, wait a minute, which one would be better for me? And then the other question that comes, or the other response that comes out of asking the question, how much of my money is working for me in year one, is it begs the next question of, where did it go? And again, I'm not looking to answer that question today. The key piece is this is a question you should be armed with, so that when the person that's designing this policy for you is saying, hey, this is the structure, this is your illustration, these are what the numbers are supposed to do over time, you can ask the question, wait a minute, if I put in 30 and I have 18,766 working for me, where did the $12,000 go?
Okay, I gotta jump in here
Yes,
because we should be answering that question for people, because they are wondering why it's not working for them. And if there's something, because when they go back into these communities, like for instance, a Facebook group or something where other people, Reddit, whatever, other people talk about strategies and what they should do or not do, or they're just talking with their agent, right, who helped them develop this policy and probably is versed on the IBC or infinite banking concept. So having this deficit in year one, not understanding what that means, because the biggest, probably top priority, the biggest sell in this strategy is access in year one.
Right.
You put the money there, then you borrow it, take it out to go do things and put it back in, but you've already like started the policy, right? Mm-hmm. And then if you're already starting with all of this money that's missing, where is it going? Does year two look like what's on this sheet? Because if you borrow it out, will it still look the same? They don't have to tell you, no, it won't look the same. Because if you wanted to borrow it out, that's an event that hasn't happened yet, right?
Right.
But the idea that you have no idea what this truly looks like if you're using it for infinite banking, or how to be able to do that math, or how to run those numbers, or see an illustration that looks like it's realistic for your use case, right?
Right.
So where are the fees going? Well, put it in the comments below and check out how many people are aware of where those fees are going. And if you're not, it kind of makes you feel some kind of way, right?
Well, and I intentionally didn't put it in here because I anticipated being asked. Because in high level, what does that look like? Inside of a whole life policy, this specific policy, 30,000 was put in, there's 18.7 available. Where did the remaining or the additional 11 something, 11,200 and whatever dollars go? Where did it go?
Yeah, I'm asking for a friend.
Well, if you talk to a lot of the agents who structure policies this way, one of the sells for whole life policies are their low fee structure, right? It is communicated that the reason you want a whole life policy is because that whole life policy has zero fees or very low fee structure. Okay, if that's the case, then where did this 11,000 whatever go? In most cases, the difference between this 30,000 and this 18,766, if it's not a fee, it's a commission. If it's not a fee, then it went to 9 times out of 10 the company and or the agent that created it. Now, if you're asking me personally where it went, it's a combination of both because all cash value life insurance policies have fees. You can't tell me that they don't. They're all structured the same.
Right.
But the majority of that 12,000 is absolutely a commission. And when we come over here to this index universal life insurance policy, put in 30,000, there's a $600 deficit there. What are those? It's fees. And I know the fees inside of IULs. You can't find a fee page as it relates to a whole life policy, but you can easily print the fee page on an IUL, and there's 3 buckets of fees: premium charge, expense charge, and the cost of insurance.
Okay, but that's not 12 grand.
So my point is, the product matters, right?
My point is the math is not mathing on why people have, well, actually, it doesn't. If you're really truly doing math, it doesn't math on why people would read his book and still be choosing to
I can
promote it
help.
through whole life.
I can help.
Unless
I can help. Because here's where, because obviously what you're seeing here is this product bad, this product good. But here's the truth. If we're talking about, remember, what's the goal? The goal was I want liquidity to be able to invest. So which one gave me the maximum amount of liquidity to be able to invest externally? Well, inside this whole life policy, out of your 30,000, we don't like the difference between 30,000 and 18. But as far as which one gave you more money to go invest, this one gave you 18 grand. Well, between these two columns, which column is the one that allows you to borrow against and use for external investments? Well, the accumulation value column is how much money is working for you in the policy. The surrender value column is how much you can use to go invest. So if we're looking at year one, which one gives you more money to go externally use it and go do something? Well, in this policy, it's $13,598. In the whole life policy, it's $18,766. So if I'm a salesman and your job or your goal is to be able to access as much as you can to go invest, which one of these will give you the maximum amount to be able to invest? Well, it's here.
if you're focused on leverage,
If you're
available
focused on
leverage.
being able to use the money externally, in year one, a whole life policy will beat you every time.
Okay, well, is there a missing column?
There isn't. Because this is where we have to break down the goal. If the goal is year one liquidity, you are not going to find a policy better than a whole life policy for year one liquidity.
No, that's not true.
It is 100% true.
No, because nobody is paying $12,000. Nobody's paying.
Now you have to finish the sentence.
Yeah. Okay.
Because you having the maximum amount of liquidity in year one is just part of the conversation. That's not the goal. No one gets an IBC policy for year one liquidity only.
Nobody's breaking $100 bill going, can you give me cash? And they're like, yeah, but you know what? I've got to take $40.
Exactly. That's where you have to play this all the way through. Okay, that's year one. What happens in year two? What does it look like in year two? What does it look like every year after that? And that's where we have to ask better questions. But the second one is about what's happening in year one, because that tells a story. And then once you get that story, then you move on to the next question.
All right.
And the next question is the death benefit itself level or is it increasing? Is it level or is it increasing? Why does that even matter? Well, your death benefit being level or increasing over time dictates how much cash value you'll actually have access to. So in this case, the death benefit column for both of these policies are here. Is the death benefit getting larger as the years progress? The answer is yes. Is the death benefit larger as the years progress? The answer is yes. So because the death benefit is increasing, that means my cash value is growing. But again, that's just one more question to make sure you're looking at, because if the death benefit was not increasing, that means my accessibility that I have to the liquidity that I want to be able to do infinite banking may be less. So again, it's just another question to ask. Is my death benefit level or increasing? And what do I want? I want an increasing death benefit so that my cash value will be more accessible. Okay. All right. And the next question is product type. Oh, hold on. Product type. Meaning, not all policies perform the same. I have a lot of clients who want to share their policy with me, and they go, I have an infinite banking policy and it's a whole life policy. And I ask, where did you get it? Getting a whole life policy from State Farm and expecting to do infinite banking versus getting a whole life policy from Mass Mutual and expecting to do infinite banking are very different products from very different companies. So the product type matters. And in this case, what we're talking about is whole life compared to an IUL with leverage. Notice, this is not just an IUL. This is an IUL that has a leverage component to it. This IUL plus this leverage component is very different from what we would just consider an index universal life insurance policy, IUL, index universal life insurance policy. The product type matters. And again, it goes back to your goal. Based off your goal, the product type might look different. But if the goal is liquidity, if the goal is growth, if the goal is maximum growth, you want a product that can give you and provide you with the maximum amount of growth. This leverage factor does what? This leverage factor allows you to build cash value faster. And I will jump to the end to identify what that looks like. If you were to take $30,000 into a policy, we've already identified that year one, there's a lot less cash value. But as you compound over time, that cash value gets greater. You've put in over a 20-year period, 30,000 times 20, $600,000. And in total cash value, you've got 776,000. So your policy's grown, your money's made money, and someone's going to sell that to you as though that's great. But when you're dealing with an IUL that has a leverage component with it, that same $30,000 over 20 years, that same $600,000 has an accumulation value, meaning total money working for you, 4.5 million. 4.5 million compared to 776. And if we're asking how much of that 4.5 million is accessible to you to be able to leverage and use, to be able to do other things, it's 1.2 million. Again, you've put in 600,000. You've got 1.2 million available to you. Your total amount available has doubled over this period of time compared to you've added about 170,000 inside of this policy. So which is better? And again, that's where I go back to product type. Product type makes a difference. Understanding what product you have makes a difference as to how this product grows. All right.
I have a question.
Ma'am.
Because IULs are, I would say they're still fairly new. If people are just now talking about Roth and it came out after the IUL dropped, right? Then we have to consider that from a common marketplace, IULs are now a new thing for people. They're still learning about them like for the first time, right?
Right. And there's so much, this is where insurance in general is such a tainted place because you have to understand the source. Why would I promote something that I don't benefit from, right? And so it's less about whether IULs have been around for a period of time. It's the stigma that IULs have based off who's talking about them too, you know?
Why was this more like a almost like a religious split, right? Like we're all still Christians, but we're these types of Christians. That's what it feels like in the insurance world when you're talking about whole life versus IUL. To me, anyway,
I agree.
it's giving prejudice within the church place. It's giving thou shalt not judge except for if you sell IUL or if you do whole life. Like it's like gang banging inside of,
Now that's where I was headed
yeah,
because
it
it's
is.
more like Walmart versus Target for
Yeah,
me.
yeah, it is. It's giving like who do you rep type vibes. But it doesn't matter. It's not a what do you believe? Math does not require belief.
And we'll kind of hit that at the end because that's rooted in the agent that's building these. Let's be clear. I don't care what policy you get. I work for no life insurance company. I can write policies for every life insurance company, and I can write every type of product. My focus is on you. What is your goal?
But that's not true for everyone. Some
It's not.
people
Why?
can only write for a particular company, right?
Right, and that's that financial advisor piece, right? I have a fiduciary standard that I live by, but the truth
Beholden.
is, I'm beholden to. But the truth is, my first fiduciary standard is to my broker dealer. My second fiduciary standard is to you.
I'm going to keep my comments to myself when you said broker dealer because my head was in the streets. So good job, Angelique. It's
Reel it back.
reel it back. That's right. The reason why I'm saying this is because I want to believe that, but we've seen this in the landscape of like qualified retirement plans.
Right.
When Roth came out, people were like, whoa, we get that some people might benefit from this, but don't do it.
Right.
And
the devil.
Right. And take the tax deferment today. Why would you want to pay more taxes? And they could not do the long math all the way through. Now, 27-ish years later, they're going, hey guys, there's this new thing out called the Roth IRA. And it's like, no, we're already it's not new.
Right.
And people have, don't call it a comeback. I've been here for years, right? But it's literally getting like its own mixtape at this point in the social media world and reels and whatnot. It's all over everybody's feed. And now it's almost as if they're still siloing based off of like, it's still a religious thing, like IRA versus 401k even. It's almost that same, here's why it's so important to learn what it is, what's really underneath all of these. Because if you're going based off of what your Uncle Charlie, your Grandpa George, Grandma Georgina, like whoever the heck is your confidant in talking through your financial goals, whoever those people are, if they're basing this based off of beliefs, like you're only going to get the grape Kool-Aid, right? If they're basing this off of what they like or prefer, and they're not basing this off of how things have formed over the years. And here's why I'm saying this. When IULs first came out, when Roth first came out, when 401ks first came out, when the IRA first came out, when any product first comes out, there is this period where many people don't understand how to use it.
Right.
When premium financing came out, you had to have how much to qualify to use it?
We'll get there. $5 million.
Okay. And now you don't, right? And so it's understanding how to use it. Because people didn't understand how to use it, they just knew that they qualified for it. They wanted to jump right in. So people said, oh, premium financing is so bad because look at these people who didn't use it correctly and got injured. I would say the same thing for diving boards. I would say the same thing for
anything new that you don't understand.
Building IKEA furniture. Okay, it could be dangerous. We know that. You got to know what you're doing. But the point is staying in a place where you are just listening to one person, even if you're listening to 10 different people and you're only listening for their perspective or their belief about it, that's different than looking at the math, taking it apart, understanding how it works. Because if what they're saying is the way that I use it,
Right.
it works for me. One, you don't know that that's true. And then two, if they're saying, but you must be doing something wrong if it's not working for you. If you're doing exactly what you said you were going to do when you got this policy, you think you know how to use the policy and you're trying to use it in the way that it was said you could use it, and it's not working, you need to know how it works,
That's right.
right?
And that's why today is so important, because it's arming you with just simply the questions to ask. I don't want you to be armed with the answer to those questions. It's asking the right questions and understanding that, you know what, the first person you talk to may not have an answer. And that itself is a story.
Yeah, or being able to use your discernment on who is giving you facts
That's right.
and who is giving you their beliefs about something.
That's right.
I think that's important too.
No doubt, no doubt. So product type, again, just another question to ask. The next is, where do I break even? And what do I mean by that? Meaning, when you're contributing to your policy, at what point does the money that I've put in equal what I have accessible to me? Again, why is that important? If I'm putting in $1, at what point are all of my dollars working for me? The reason this is important is because it makes you question whether or not you should have placed your money elsewhere. Meaning, if I put $1 in this product and it takes 30 years, which would be $30 for me to have $30 inside of this product, why wouldn't I have just taken my $30 and put it elsewhere? I could have put it in a high yield savings account and made more. So it's important to understand, as I'm contributing into a product like this, as I'm contributing into my policy, at what point does the money that I'm putting in equal or exceed what's growing for me inside the product? And so as we look at both of these, again, whole life, index universal life insurance policy with leverage, I've been putting in $30,000 a year. 30,000 at the end of year one, I've got 18. I put in 60 in 2 years, I got 38. I put in 90 in 3 years, I've got 64. At what point do I break even? Well, if you come down here to year 10, 10 times 30 is 300,000. At year 10, I have a total available to me inside of this whole life policy of 301. I have broken even in 10 years. Is that good or bad? Again, we're not talking about your accessibility to those funds to be able to do other things. I understand the purpose and the point of infinite banking. What I am saying is, this is a vehicle that's building compound interest. At what point does the money that I've put in equal what's working for me or what's available to me inside this policy? If it took me 10 years to get here, couldn't I have taken this same dollar amount, put it in a high yield savings account making 2%? 2% of $300,000 is $6,000. I'd have 306,000 over 10 years versus 301. So understanding when you break even is important. If I look at this index universal life insurance policy, I put in 30,000 in year one, I've got 29,435 working for me. I do not break even at year one. Put in 60,000 at year two, I've got 60,706. So I have all of my money working for me by year two, which means from this point forward, my money is just making money. Which would you prefer? My money starts making money at year 10, or my money starts making money at year two? Which would you prefer? And again, what's the goal? And again, here's the other side of this argument. That's money working for me, right? I'm being very strategic about the words I use. This is how much money is working for me inside this policy. How much accessibility do I have to this money that's working for me? Well, if you have the right strategy, this is where discernment comes into play. I want my money growing the maximum amount, and I want to be able to access those funds to be able to invest externally. So in year one, I put in 30,000 inside of a whole life policy. I have 18 grand accessible to me to spend. In year one, inside of an IUL with leverage, I have about 13.5 accessible to me. Clearly, year one, my whole life policy, I can use more in year one to go invest. Awesome. But what happens in year two? I put in 60, I have 38 total. I put in 60, I have 38 total. Inside of an IUL with leverage, I put in 60, I have 46 total, which is more. And again, I'm not saying I have the same amount that I've contributed accessible to me to go spend. Neither one of them allow for that. But which one allows you to access more? Again, year one, hands down, whole life will beat it every time. But if we're talking infinite banking, if we're talking about leverage to be able to invest, do I only care about year one? I care about accessibility to my liquidity over time. So
Okay.
from year two on, it doesn't compare. Go ahead.
Okay, this does not give you an idea, though. We're talking about infinite banking, not whole life versus IUL.
Exactly.
This
We're
is
talking
just
about access to liquidity.
okay.
Leverage. We're talking about leverage. Yes, go ahead.
Pause. Okay, this is if this is whole life versus IUL. That's what you're looking at. This is not infinite banking with whole life versus IUL.
Right.
So
Absolutely.
that's to be fair.
Right.
What hasn't happened in this policy, either one of these?
What hasn't happened is we have not leveraged the policy to do an external investment. We haven't borrowed anything to go do anything in either one. Why? I go back to the original reason why we're here. Why isn't infinite banking working for me? If your policy isn't structured right, you will never get to infinite banking.
Hold on. I want to ask a question.
Yes, ma'am.
So to the viewers, if you're looking at these numbers and you are thinking, they told me I could leverage, I could borrow up to 90% in year one. You borrow 90% in year one. Let's say you put that as a down payment on a rental property. And when the rent comes back, you are putting it back into the policy. How long would it take to repay that policy? And are you aware of what that difference would be, right?
Yes. And that was in the first set of numbers around the loan rate. This is where if you don't understand what is the cost of borrow compared to what's growing inside my policy, you could get yourself in trouble.
In year one,
Even
though the biggest sell is that the liquidity for year one.
That's right. So, and again, to put it in, I'll call it just to put some math behind it. If I'm borrowing 10,000 and it costs me 6% to borrow that 10,000, but the growth inside of my policy is 5%. Again, I'm borrowing 10,000, it costs me 6, but the growth inside my policy, 10,000 didn't come out of my 10,000 did not come out of this number. The 10,000 is still here working for me. If that 10,000 is making 5%, there is a negative spread, negative arbitrage happening at year one. And if I don't correct that in year one, that problem compounds every year after that. So as bad as these numbers might be, they continue to get worse if I am not knowledgeable of the impact of me doing infinite banking.
That's it. And so instead of breaking even in year 10, you're looking at year 20 going, why am I still negative? My policy could have imploded by then.
Which goes back to the original question as to why we're here. Why isn't it infinite banking working for me? I go back to, we have to first make sure it's designed right before we even think about the infinite banking part.
Right. And here's the point of all of this. The concept of infinite banking and banking on yourself is not wrong.
No, absolutely not.
To structure yourself with leverage, right?
Absolutely.
But what I hope people get out of this isn't just that this is a whole life versus IUL conversation. This is only comparing whole life to IUL because of the point of leverage.
Right. It doesn't matter what policy is sitting here. It does not matter. The question is, how is it designed? It doesn't matter what policy is sitting here. It's about how it's designed.
Well,
it's about asking these questions to make sure it's designed effectively. Go ahead.
It's where your opportunities are. To me, what I see is what's missing out of this whole equation. I understand that if he was selling life insurance and he was only talking about life insurance for the sake of the book, then okay. But there are other vehicles that you can use to create a banking
bank.
system,
That's right.
right, for yourself.
Mhm.
That's the big miss, is that people silo into this view of this is the tool I'm going to use when you have access, and you need to be leveraging all of your leverage where you're and being able to see where those opportunities are. When you put all of your money here, though, when you put all of your resource here, now you're crippled. You've crippled yourself, because now your resource you're not able to take advantage of these other opportunities. If you think about it, this is the exact position Nelson Nash was in when he asked himself, how do I become my own bank?
Right.
How do I remove this
Broken system.
right, that is continuing to cripple and handcuff me, and I have to ask permission, and because now there's conditions around every move I want to make. When you're doing it in this way, you are creating the same environment that he was trying to get out of. How does this make sense if we're still doing this like 40 years later, right?
Right. And I think that feeds right into the last item, which is the agent. Meaning, is it max funded, underfunded? Okay, we can answer that question. How much money is working for me in year one? Is the death benefit level or not? The product type? Where do I break even? But the biggest piece around all of this is who's doing it, is the agent. Because I don't expect you to have the answer to all of these questions. But what I do expect is the guy that created it to be able to walk you through where and what the impact of all of these features are as it relates to the structure of this policy. And it is all built on or based around the person that's providing it to you. If the focus of the agent is on anything other than you, be careful. Because if the agent is focused on your goals, which is liquidity, accessibility, can I borrow against? Yes, I want access to as much as I can in year one. If that agent doesn't go, I can get you maximum access to as much as you want in year one, but let me explain to you the impact of leveraging majority 90% in year one is going to have over time. If you're not having that discussion, you need to question why, because it's rooted in who benefits from this structure not being the most efficient possible for you to maximize the cash value so that you can do everything you want. And again, it's rooted in asking these questions of the individual or the company that has created it, because not all are the same. So this idea of a leveraged IUL or leverage added to an IUL being somehow way more powerful than a whole life policy or what we've kind of walked through today, somehow is this new? To your point, it is not. It's been around since, 97? Premium financing is what this strategy is built on, meaning premium financing has been around since 1997. The ability to add leverage into a policy has existed for quite some time. The fact that you don't know about it or it hasn't been provided to you, there's a reason why. It's because premium financing itself is a strategy that requires some, I'll call it boxes to be checked. Meaning it's a strategy where we use bank financing as additional leverage or additional premium being added to your policy, and that spread being created by the money being borrowed from a bank at a low interest rate, and that low interest rate dollar amount growing over time, that spread you get to keep. That strategy has been around a long time, but in order to qualify for that strategy, you have to, one, have $5 million in net worth. You have to have pristine credit. You have to be very much credit worthy, because if I'm borrowing money from a bank, the bank wants to make sure that that guarantee basically the guarantee around that money being borrowed is going to come back to them. So there's some boxes that have to be checked. But here's the thing. As long as your life insurance company allows for leverage to be added back, there is no requirement. This is not required. So if you are dealing with, this is where that product type and the company the carrier that you're working with comes into play. As long as your life insurance company allows for the index loan, the money being borrowed, to be added back in as brand new principal, you are golden, which means you are allowed to have a product with leverage in it. Yes,
Okay,
ma'am.
wait, because some people go, oh, no, you could do this on your own. What's that called?
What do you mean?
You, some people say,
Oh,
oh, I,
the hyperfunding?
yeah, some people say, oh, I could just do that on my own. Why do I need an insurance company that will allow me to do that?
Yeah, that's actually illegal. So the ability to borrow funds from your policy and take those borrowed funds and put it back in as brand new premium, unless you are following strict guidelines, it is absolutely, it will be borderline impossible for you to do so. Your policy will implode and you will lose all of the, I'll call it tax favorability associated with that policy. So it goes back to this part. As long as your life insurance company, not Donnell, not the agent that created it,
Right.
as long as your life insurance company allows for leverage to be added back into your policy in the form of the index loan, there's no bank financing required, and therefore this strategy is allowed to take place. This isn't a Donnell rule. This is a life insurance rule, and there are very few life insurance companies that will allow that to happen.
Yeah. Okay. Well, carry on.
So what does that match or adding that indexing loan into a policy looks like? And again, we've been talking heavy about leverage. This is where secure leverage comes into play. This is literally as it states, the growth inside your policy being borrowed and that growth being added back as brand new principal. And that match is built on or based on what it is you've saved. And I'll get into that. That match can increase every 2 years, meaning it doesn't start at year one. But once it starts, that match, that leverage dollar amount that's being added back into your policy can increase every 2 years. And that match increased results, meaning the result of that match being added to your policy can cause your cash value to exponentially get larger. And if a lump sum is added, that match process can actually start in year 2. What do I mean? Well, this is a zoom in of the IUL side of this process. Again, it's the same 30,000. It's the same accumulation value, same surrender value, same death benefit. But what we're adding here is the leverage. What does the leverage and or match look like? Well, notice in year one, you put in 30,000. Is there any match? No. That 30,000, there's about 29.4 of that working for you, which gives you accessibility to about 13.5. Again, if we're comparing this year one to a whole life policy, I'm going to say just about every whole life policy that's properly designed will outperform a strategy like this in year one. But from year 2 on, it's game on. That second 30,000, which gives a total of 30,000 being added into this policy. Again, properly designed, there's no leverage being added. There's no lump sum here, so we're not starting in year 2. But notice the accumulation value is 60, surrender value is much more. But because you've built up accumulation value of about 60 grand, the life insurance company says this: congratulations. You are now approaching year 3 inside your policy. Because you've consecutively contributed, because you've maxed funded your policy for the first 2 years, you have the ability to take everything that you've contributed in year 1, borrow it from your accumulation value, and take that borrowed dollar amount and put it back into your policy at year 3. I said a lot. Because you've max funded your policy in year 1 and year 2, starting in year 3, you're able to borrow everything from year 1 from the life insurance company. So you're borrowing against your cash value of 60,000, borrow everything you've contributed at year 1 and add that dollar amount as brand new principal into your policy. So which means you're borrowing $30,000 from the life insurance company, adding that to the $30,000 you're contributing. So what that means is in year 3, you've put in 90, but the life insurance company's put in 30, which means there's $120,000 working for you. And as a result, these dollars allow that accumulation value to be much larger than it would be inside of a whole life policy, and therefore giving you accessibility to more cash value than you would otherwise. This is where this policy starts to take off. That's just year 3. At year 3, you're able to borrow everything from year 1. At year 4, you're able to do it again. But as this stated, the match can increase every 2 years. So at year 5, guess what happens? Not only can you borrow everything from year 1 at year 5, but you can also borrow everything from year 2. So this dollar amount gets added together. 30 plus 30 is 60. You're now able to borrow $60,000 from the life insurance company. Add that into your policy as brand new premium. So now you have all of what you're contributed plus all of what you've borrowed earlier, plus an additional $60,000 added on top. Hopefully what you can see is not only is your accumulation value compounding, but the amount of cash value that you have available to you to be able to spend starts to exponentially get bigger. And again, if we were just looking at this from an apples to apples perspective, and let's take life insurance out of it. If you had a 401k and you worked for a company that had a 401k with no match, then you left that company, put the same dollar amount into a 401k with a match. Doesn't matter how much the match is, which one would allow you to generate and build more money? Clearly, having a product with a match, having a product that uses other people's money or leverage to be able to grow would allow you to make more. And that's what's happening here. And if you notice, every 2 years, this number doubles to the point where in 20 years, you would have contributed 20 years, $30,000 times 20 is 600 grand. All of this leverage added together, plus your $600,000, that's a total accumulated amount of 3.36 million in 20 years. 600,000 of it came out of your pocket. 2.7 million came out of the life insurance company's pocket. We just, again, on GP, if you were to put those $2 amounts together, which one is likely to have a better performance? Inside of a whole life policy, I'm only putting in 600,000. Inside of this IUL with leverage, I'm putting in 600,000 plus 2.7 million. Which one is more likely to be able to put me in a position to be able to have more cash value to spend?
Okay, but a lot of people say, but it's based on the market, whereas you have guaranteed 4% growth.
Yes,
with whole life.
that is true.
That's where some people go, you know what? The safe thing sounds like 4% guaranteed. That if you're just basing it off of risk assessment alone. So what do you say about that usually when people talk about that? Because people want the assurance, right? That's fair.
Yes. And not only do people want assurance, let's go back to me personally. I'm 52 years old. I don't have time for loss. So I'm just like you. I need security. I need to make sure my money, like this is a lot of leverage.
Yeah, he doesn't even like to try new foods, guys, because he needs the assurance. So we just, he falls back on Chipotle, Taco Bell. Yeah.
I'm sorry.
Yeah.
It started in college.
For decades. Yeah.
It's a struggle meal that I love. I can't help it.
It's assurance, right? That you're going to like it.
I know what I'm going to get, right? I know what to expect. And so to your point, whole life policies has its positives. The positive around whole life is the guaranteed growth, which is awesome. Don't discount that. If we were talking apples to apples, a whole life policy with guaranteed growth compared to just an IUL, I can show you a whole life policy that will outperform 80% of the time. So I get it. But here's the difference. The guarantee inside of an IUL isn't the growth. The guarantee inside of an IUL is no loss. So I have a contractual guarantee from the life insurance company that says my $600,000 will never lose. And in addition, I have a contractual guarantee from the life insurance company that says any money that I borrow from the life insurance company that includes this 2.7 million, there's a contractual guarantee that says I won't lose that either. So the risk of loss of any of these dollars, there isn't any. And when you take the growth on this leverage dollar amount and add that to what I've contributed, because there's a guarantee that I can't lose any of it, that's what allows this dollar amount to outperform the guaranteed dividend growth of a whole life policy. It goes back to, it's just math. It's just the fact that because there's more money working for me, and there's no risk of me losing this money that I've contributed, nor is there risk of any of the growth on the money that I've put into this policy. Because of that guarantee, it will outperform a straight, flat dividend growth of 4, 5, even 6% every single time. It ends up just simply being math. And so when you put all of this together, as it relates to I've got a whole life policy with guaranteed growth. And again, I put in 600,000 in total. Working or accessible to me would be somewhere around 776,000, which is good. But when you add this leverage factor along with what it is I'm contributing, these two dollar amounts together gives me a much different story. That same 600,000 that I've contributed turns into 1.2, meaning I have doubled what I've contributed into this policy over the same period of time. Why? Because I had help. I had help in the form of leverage. How about this? If we apply this leverage to this same whole life policy, how much greater would this be? So I go back to, it's not the product itself. It's the fact that the structure of this product compared to this one is what makes it different. It's not IUL versus whole life. It's really not. It's this IUL that's designed to specifically accept leverage is what makes it makes the difference. You take the leverage away, I would argue that this whole life policy could probably be structured better. But when you add this help, when you add this support of 2.7 million with a guarantee that it can't be lost, it's a game changer. So, moral of the story is it's not new. So to come back to the question, how do I make sure the infinite banking concept is working for me? How? It goes back to structure. It goes back to making sure we are asking the right question. Is your policy max funded? Is it built with the least amount of fee structure? How do you know? Well, first I have to ask, and then I want my agent to break down whether or not it is. Tell me where the money is. If I put in 30,000 and I only have 12,000 in net cash value, I can accept it if you can tell me where my money is. If I put in 30,000 and I only have access to 13 grand in year one, did I lose $17,000? No, it's actually still sitting in my accumulation value working for me. The only reason I don't have access to it is this little thing called a surrender charge. The surrender charge is a what if charge, and every year that money gets released back to me. So I didn't lose my money. My money's still working in my policy for me. But if the person that designed this can't explain that, that's a problem. Increasing death benefit. The death benefit increases says I have my cash value is it being placed in the best position to be able so that I can have access to it to be able to do infinite banking. Is it an IUL? Is it a whole life policy? Is it a variable life policy? Is it a universal life policy? Does it allow for leverage? Does it allow for a match? If it doesn't, I want to ask why. I want to compare and contrast. Before I get that policy, I want to compare it to one of these, because I want to know whether or not there's a better structure out there that can give me more cash value. Where do I break even? The break even point truly depends upon your rating, because this is life insurance. Life insurance does require an exam, and that exam will provide you with the rating. Preferred plus non-tobacco, preferred compared to something less than that. So where your policy breaks even matters. I can show you a policy that breaks even in year 4, 5, or 6, but it still be a very powerful strategy and product based off the leverage being added. But this is absolutely a key piece to understand whether or not your policy is structured correctly. And the most important one on this list is who's designing it. Is it designed for you, or is it designed based off someone's commission? Is it designed for you, or is it designed with all of these fees that's making the life insurance companies money? Is it designed for you? Is it structured for you to be able to maximize the efficiency of the product and also produce the maximum amount of cash value? And why does any of that matter? It's because the system, it's because of the system that you're creating. Meaning, when you put your money in the right system, a properly designed cash value life insurance product, and it's doing what it's supposed to do without you having to think about it, those things that you can't control, you've made sure up front before you started that policy that it's structured the way that it needs to be. That means your capital has been placed in a position to compound. You've put your money in the best position possible so that when you go to leverage that dollar amount to be able to make some type of external investment, and you put that dollar amount into a deal, and that property or that real estate venture or that hard money lending, wherever it went, it performs. And then that growth, you put the principal and interest that you owed back into that policy, and then you rinse and repeat this process, you've now put your money in a position to where it's working for you in 3 different ways. Meaning, you've got the right design product that you've put in it and it's making a return somewhere around 7 to 10%. And you have leverage added to your policy that's making you a return somewhere between 2 and 5%. And then you take those dollars, you deploy those dollars into an opportunity that's also making money for you. And then you rinse and repeat and do this all again. You have now placed your money in a position to make money in 3 different ways. Show me another product that will allow you to make money in 3 places. It's going to be quite difficult. We started this conversation around leverage, around putting your money to work for you, understanding the different types of leverage. What if you had a product that allowed you to generate and build leverage in 3 different fashions? Again, you've got that 7 to 10% growth on your money. You've got that index loan that's making you 2 to 5. And then when you deploy those dollars into an opportunity, what this allows for is discernment. Why would I take money out of this process if the opportunity wasn't going to produce more than what this is producing? Let me say it again. If my $30,000 is making 10% and the $30,000 that I borrowed from the life insurance company is making 5%, that means my money is making somewhere, and again, it's not an exact 15%, but my money is making somewhere between 12 and 15%. So if this process is making 12 to 15% for me, and when I borrow this money in this process at 5%, again, I pulled it out of this process and it's costing me 5%, I better damn well be making at least more than the 15 where this money was originally sitting. It forces or it causes discernment. It gives me the autonomy to go, you know what? I'm not going to go after that opportunity. Why? Because there's no benefit to me to break up this uninterrupted compound interest. But when there is opportunity, now I have money working for me in 3 places. And so what this all boils down to is freedom. You having control over your dollars, to have access to liquidity, to be able to put them in a position to be able to do what you want. So last week we were talking about being able to do that with the 401k, to be able to generate and build mailbox money. Today we're talking about if you structure a policy correctly, infinite banking will absolutely work for you because it's designed right, which gives you access to liquidity, which allows you to do what? Be able to build your own ecosystem, which gives you autonomy to do what? Now, who cares what your credit score is? Who cares how many bankruptcies you've had? Why? You've got your own system that you're able to leverage and use, which gives you what? Freedom. You get to break away from those systems that place some type of expectation on you to be able to perform within their system. You now created your own. And this is just a small piece of it. But ultimately, if done right, if structured correctly, you're given the flexibility you need, the choice that you want to be able to do whatever it is you want to do, and the control to be able to take action when you decide. This is absolutely the key to doing all of that. And as it relates to what it is we do, there are many strategies that we talk about on this channel. Majority of them are around properly designed retirement accounts so that you can access and invest and put your money where you want. Today was about a properly designed secure compound interest account in the form of a life insurance product with leverage. But there are other types of schemes as well. There are annuities. There are many different opportunities for you to be able to put money to work for you, to be able to access leverage, to be able to invest in what you want, how you want. And if you want to learn more as to how to do that, take yourself over to selfdirected.info, jump on my calendar, and let's discuss. As I mentioned, this started out with, hey, why isn't my infinite banking policy allowing me to do infinite banking correctly? As I stated, there's no such thing as an infinite banking policy. It's a strategy. So why isn't your policy structured correctly? You've got to ask some questions. I don't expect you to remember all of the questions. I don't expect you to watch 2 hours of a live stream, to be honest, to be able to get those questions. The easiest thing to do is to jump on my calendar, bring your policy with you, And it will take me all of 30 seconds to identify whether or not your policy is efficient or not. And based off whether or not your policy is efficient, I can also share with you some actions that you can take to be able to improve. Sometimes there isn't any, meaning if you've got a policy you've had for 5, 6 years and it's not efficient, there's really not much you can do to fix that. So the best thing you can do is let that one go and start a new one. But in some cases, if you have cash value and it's just not working effectively the way we've kind of identified, you can do a 1035 exchange of that cash value into a new one to be able to put yourself in a position to be able to do what you need. So it just kind of depends. But the best thing to do is to jump on my calendar and let's talk about it. I think that's it.
Okay. That was one of my questions. Like somebody's watching this and they're going, I have a whole life policy. It's not giving what it needs to give. I'm tracking based off of what you're showing me.
Yep.
And now what do I do? I'm already into this thing. Like it's not my fault that I'm here, but we have arrived at my what the heck moment, and I want out of this, or what do I do at this point? Because I can't obviously just walk away. That's a lot of money I put into these policies.
Man. And I'm from the school of you don't know what you don't know.
Right.
What I hopefully, and maybe you can confirm this or some of the people in the chat can confirm this, my objective is to create a safe space. There's no judgment here. A lot of times we don't know what we don't know. And how about this? A lot of times the agent that sold you that policy, your friend, your cousin, your next door neighbor, who you have a great relationship with, a lot of times they don't know what they don't know. So it's identifying where the opportunities are and then just breaking down or providing a solution to be able to solve. And again, it's not about judgment. It's not about what you've done something wrong. I don't look at it that way at all.
Yeah. Nobody cares what decisions you've made as long as you are on the path to educating yourself and making better ones. We can get really hard on ourselves sometimes in the decisions that we've made, right? The mistakes, or gosh, I could have done that so much better. Gosh, what is going on? Hair keeps
hairing.
No, my hair is like, I don't know. You hit an age. Yeah, my hair wants to, you hit an age and all of a sudden it just starts doing what it wants to do. The point is that we have to treat ourselves with kindness if we're going to be successful. That's that mindset piece, right? And leveraging the mindset around. And I think that is sometimes when people jump into communities and they go, wow, like I'm digging the idea and the energy here. Even if we're all headed enthusiastically in the wrong direction, I love it. like you see a lot of people even in velocity banking communities, right? You're going, why? Oh my gosh, this is going to hurt people financially, this advice and this like camaraderie around certain concepts. But you can't stop them because the energy is right. They're like, hey, I don't care. We can all be burning as long as we're burning together. And, people get to make those decisions, not educated ones, but they make decisions based off of what's valuable for them at the time.
Right.
That's just, that's what it is. But the point, the question that I had was how people might be feeling watching this and going like,
a lot.
Yeah, it is a lot.
It's heavy too.
Yeah. There's something interesting that came out of this though. It was, let's see here. Low Dog's in the chat.
What's up, Low Dog?
And he was saying, shouldn't it be more than 20% because of the 5% charge for the loan?
Shouldn't it be more than 20% because of the 5% for the loan?
Hold on. So yes, you have to account for the loan, right?
Mm-hmm.
Okay. And whatever spread, we don't need to jump into math without warning right
well,
now.
I think I just want to, let me restate because I want to make sure everyone is clear as to what he's asking.
Okay.
If I'm making 10% on my money on average, and I'm making 5% on the leverage money, I'm making 15% inside my policy. And what I was saying was, if there's an opportunity you want to take advantage of, it should at least outperform what my money is currently doing in this system, at least. So it allows for discernment. And so to your point, if I'm making 15% inside the policy, but it costs me 5% to use it, theoretically, I'm still making 10% inside the policy, but it did cost me 5. So what do I need to be making outside to be able for this to make sense? And I'm with you. It should be significant. I don't know that it needs to be 20%, But I would want to at least be making something more than 15 for this to make sense. And well,
You're going to do it, aren't you?
if it's me we're talking about, I'm kind of with you. I need it takes me a lot. It takes a lot for me to move. And I'll give you some insight. We've got a few self-storage facilities. We are hard money lenders all over the place, and there's not an opportunity bringing us less than 20%. I personally like 12% paid out in 1% increments monthly. Notice 12% is less than 15, but that's just the interest on the money that is being used. I'm also expecting something on the back end when things sell or when things end. So I'm expecting
Right.
a 10, 12, 15, 20% bump. So when you add all of that together, yeah, it definitely better be making more than what's in that than what's happening inside my policy. I go back to, it's somewhat to each his own, but at least at minimum, you want the action that you're taking externally to be outperforming what you're doing internally.
Okay, fair. I thought you were going to jump into some math with no warning.
Calculators
some
not
of
even
us,
up to that.
no,
Although,
no, listen,
so
stop it.
you said, let
Stop
me
it.
say it.
Don't do it.
One of the
Some
items
of
I
us had
took off the
PTSD
list.
from last week.
Hold
We're
on.
still
One of the items
healing.
I took off the list
Okay.
was IRR, internal rate of return. That is one of those items that if you want to understand if your policy is effective or not, calculating the internal rate of return is a way. If someone in the chat would like for me to calculate internal rate of return, we can do it.
Look how excited you are right now. Look how terrified I am. I'm still on my healing journey with the maths.
It's for that reason.
Yeah, I had PTSD for like a solid 24 hours after that. I was just like, why? Why with no warning? But some people really loved it. So I love that for them. I do. But here's the point why I was bringing this up. Because Gabo was saying there's not a single bank that loans at 5% interest nowadays. So your cash value loan will probably likely beat any of the bank rates. And while that could be true, guess who's loaning at 0% all the time? This is what I was talking about in terms of like arrival syndrome or siloing, when we're only considering two factors, right? We're only comparing against something else within that. This is that streets, conversation. Like if we're only looking for people with that identify or a rep in this other thing, and that's only what we're comparing it against, we are missing out on opportunities, or we are ignoring other threats. Point being, there's cheaper money out there. Why would you only be borrowing from a life insurance policy if there's cheaper money out there? You can't, though, if all of your capital is tied up in this policy. That's the problem, is that you're only considering that this is one gear in this gear is your machine versus it is a gear inside of the machine that you're building.
Which is why we spend so much time talking about leverage today, because it is not just about why isn't infinite banking working for me. It's when you understand where leverage is, you look for it everywhere.
Yes.
It is all over the place. The best thing that you can do is understand how to access and use leverage wherever it is.
That's it.
Yeah.
And it could be inside of your self-directed 401k where you have full control. It could be inside of your inside of an annuity, maybe even for you. It could be inside a combination or collaboration of a multitude of tools.
Very much so.
And some of these tools are based off of what you had available at the time, and then you build your machine from there. So if you haven't made the decision on what gears are going in my wealth machine, if you haven't taken a full assessment on what gears do I have in my wealth machine, like that's step one. If you are looking for somebody to help you sort it out, to say, where's my leverage? This is the guy. If you wanted to just have a conversation that says, listen, I really don't know what I have available, but I have these things. Like, how can I use them differently? If it's the how can I use them part, that's what we do here.
Right.
We're not telling you what to invest in. We're not telling you necessarily how to invest in things. It's how can you utilize the tools that are available to you. Now we can share
with tools.
Yeah. How other people have used them, how we use them. The results that we've gotten are the results that we have achieved, hands down, has been a lot of other people telling us what we couldn't do.
There's a lot of spaces that on I guess on the surface we probably don't belong in.
Yeah.
But when you have access to leverage, it allows you to participate in spaces that regular people cannot.
Yeah, and I think it's been consistently been our focus on leverage. So if there's one takeaway from everything that we talk about, it is that leverage should be on your top priority. Not just leveraging things, because then you may not leverage them responsibly, right? Understanding leverage, understanding how to identify it. You probably walk over it every single day. I know I'm still walking over leverage, not understanding where some of these opportunities are or how it connects into our machine. Once we see something though, you can't unsee it. That's the coolest part about this, is you can't unsee it. And so therefore some of those decisions looked like amazing opportunities last month or last year or 3 years ago. Whereas now we wouldn't even look at them, right?
Right.
That wouldn't even be a consideration for us because it would have to meet this criteria based off of now how we value not just being leveraged, we are leveraged all the time, but also leveraging others.
That's it.
Yeah.
Yeah.
So that's the point that I wanted to make, was that there's cheaper money. It is not this is how much this policy loan, or this is how much it would cost inside of this policy. You are only then governed by what the insurance company or your policy provider would allow for those types of conditions, borrowing, if that's where you're putting all of your money, right? So if you have other options and you understand other options, for instance, being able to borrow from yourself. Again, becoming your own bank is not a life insurance thing.
Right.
It's just a book that a guy wrote, and he only included life insurance.
Right. That was the tool at the time. And again, it's a tool. It's the system being used. But when you understand the power of leverage, it's everywhere.
Right. Yeah. And that's what makes this amazing, is that when you start to see it, it feels like freedom. It feels like you have choice. It feels like you finally have the autonomy to make decisions to change your future. It feels like I can sleep because I know I got this. I can sleep because I know that tomorrow I can look for opportunities, or I can identify when they're coming my way. I understand now that my profile is about to change. And when I realize, holy cow, if more people knew what we were able to achieve just having access to information, I think our big flag that we fly is kind of a middle finger resistance. I don't know how else to say that. Rebellion, more professional way of saying that. Edit that out. Okay. It's giving. Yeah, exactly. Is to everyone who is gatekeeping this information.
Right.
It was really difficult when we were calling anybody that we knew and trusted, and we were asking them these questions like, wouldn't you know the answer to this? Of course you would. You should. Why don't you know? Okay, well, then you would want to know, right? So we're asking this question. It's a great question. You agree it's a great question. Why wouldn't you want to go down this rabbit hole and find the answer? Who benefits? They don't. They didn't want to. So we did. And now we're just giving the tea away. Get in here and come with us and change your life and your family. Okay, so that's, now that we've got that out of the way. Okay, I'm trying to get through the comment.
Oh, gotcha.
Yeah. My hair is reacting to all the math. Facts. It does. Okay. I think we're
Caught up?
Yeah.
Good.
Who is gatekeeping this information? Anybody who has some sort of $10,000 course or coaching program that they can't just share it with somebody. And here's the thing. If you have to charge for this information and you're not making money because you are applying the information, you're making more money off of giving the information away than you are off of
The information itself.
applying the information.
Yeah.
That's the part where I felt like we're free. We are free from all of this BS that everyone else is doing. When I realized that we make more money, our machine is not dependent on the people who we talk to. Our machine is not dependent on anybody at this point. Our machine is self-sustaining. So every dollar that we put into the machine only just makes the machine bigger. Now those dollars are for our grandkids. Those dollars are for our great grandkids. Those dollars are helping somebody else other than us at this point. That is where we knew we needed to be. Where we can help other people, and what our results will be is not dependent on people who need help. And I think many industries could be designed that way. They're just not. So who's gatekeeping? There's too many to list. I'll tell you that. Who's not gatekeeping? Right here. And I think that's you. If you're watching this, you're not gatekeeping because you're going to share this out and invite more people in to get this information, or you're just having these conversations with it inside of your own living room. We don't need the credit for it. Just start sharing, start opening up conversations about this stuff. Like, what does your machine look like? Do you know how the machine runs? I know this is uncomfortable, but you know what else is uncomfortable? If you would look at the senior living that they're doing for low budget, that looks uncomfortable. I would much rather have this uncomfortable conversation than have to deal with what is coming down the pipeline for those who have just assumed that solutions would be there for them.
Right.
And I think that's at the heart of where everyone's looking at these different strategies. The majority of people are probably looking at these strategies and they're not in their 30s, right? They're not in their 20s anymore. And they're looking going, yeah, I get that time is the most valuable asset, but I can't unsee how much time I wasted and where I could be right now had I had this information 10 or 20 years ago.
Right. And we are all in different places, because I think a lot of times, a lot of the calls I have, the assumption is I'm supposed to have everything now, right? I'm supposed to be in velocity banking and have a first position ELOC. And no, it's meeting people where they are. And the key piece is to get started. The first step is to pay yourself first. Put yourself in a position so that you can generate. So the vehicle that you decide to use to do so, it's kind of up to you. But as you get the first one in place and it's doing what it's supposed to do, you understand how leverage is used, you understand how the structure of the product and how it works. Then you use that cash flow that you're generating, that growth that's being achieved, and you move to the next one. And again, we're sharing with you our machine and our process. That is not everyone's approach, meaning I don't talk a lot about crypto because we don't have any. But if I had crypto, I would be leveraging against that, because that's a great tool to be able to use to do so. So it's understanding where your leverage is and how your machine needs to be created or developed to be able to accomplish your goal.
Yeah. And well, we do talk about rental income, and we really don't, we're not landlords.
Not anymore.
But the cool part about that is you don't have to be an expert in these fields to make money in these industries. And that's the craziest part. There's so many people who are, they're just selling the information so that you can even just get into the industry. You could have already been making money with the money that you paid for that information. Make it make sense. That's the part, is, golly, we don't know what we don't know. And I get some people want to jump in, but is it true that you really want all of that information and you really want to go get your master's in real estate investing or whatever and pay these high fees just to learn how to invest in real estate? Or could you learn on the side of somebody else and you gave somebody else your money to go invest for you? You know for a fact they're not going to mess this up, and you have some assurances there. You're getting money in return, and on this, and you're not paying to learn.
Right.
You're getting paid to learn. Like that exists out here. Crazy, right?
Mailbox money.
Yeah, it's yes. But the point is, some people are just paying for the information.
Right. Haven't even got
First. Now they got to go find more capital to be able to invest, right? And then they're telling them, go find OPM, go find other people's money to invest. And we're going to teach you how to do that. If what they're teaching you is start up a course and start selling the information so that you can get money to then go invest in with right?
Right.
Because that's all they're doing. It's frustrating to me because I know for a fact that we have been a part of communities where you don't have to pay to learn and then go. We didn't want to do that. I don't even want to tour a property. I don't even really care. Show me the pictures. I love that. Well, that's not true, because recently I did say this particular investment that I am super intrigued in and we're jumping in on. I do want to go there. That's the first time. I normally don't care at all. Have never cared. But that one I do care. And it's just probably because of where I am in life or whatever. But whatever, get the choice. How about that? You get the choice. And choice and freedom and autonomy is what you get when you have control.
Amen.
Yeah. Okay. I think we're caught up on
Perfect.
Yeah. Oh, we have a Hey Kevin, welcome in. We're just right here at the end. Okay, well, there's lots of comments in here just about being, planning for the future and being broke. Everybody's in agreement. And also, Gabo, I just want to say I did read your comment, and my bad. I wasn't reading the comments. If there was spelling errors or whatnot. We'll leave it at that. Okay. Any last words?
I think we said it all. The idea around today is just understanding another level of understanding around where leverage is located and what questions to ask to make sure that you aren't being taken advantage of. Again, it's about you asking the question. I don't expect you to know the answer. It's about asking the question and making sure the individual that you're talking with can break those areas down for you. So.
Yep. And it's you saying, I'm not going to wait for other people to value my time, knowing that my time is the most valuable asset that I have. And on that note, we are so glad that you have invested your time here with us on these live streams. So I think that's about it. We like to end with, if you didn't come from a wealthy family,
you can make sure a wealthy family comes from you.
So stay tuned.
Stay protected.
Stay focused.
Stay connected.
I'm Angelique.
And I'm Donnell.
And our goal is to help you
get self-directed.
And to do that, we have a ton of free resources, so don't sleep on those. We'll be right back here next week, Tuesday at 5:30 Pacific Standard Time. We hope to see you then. Have a great night, guys. Thanks for tuning in.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get
self-directed.